There is a specific date on the calendar when you can stop working forever, and almost nobody has ever shown it to you properly because most financial advice is designed to keep you emotionally occupied instead of mathematically liberated. So tonight I want to perform a forensic audit on your working life. Not your personality, not your dreams, not your hustle, just the math, because the math is cleaner than the mythology. Imagine waking up on a random Tuesday morning. You check your investment accounts like you sometimes do while your coffee is brewing, and you notice something genuinely strange. Yesterday, while you were at the office putting in your 8 hours, your portfolio generated $412 in gains. You do some quick mental math. After taxes, your take-home pay for that same day of work was about $320. Your money made more yesterday than you did. This isn't a fluke. It is a mathematical phase transition. Your investment income line has finally crossed above your expense line, and the lines are not going back. This moment is called the crossover point. It is the specific date on the calendar where you officially win the game of capitalism, and work becomes a choice rather than a necessity for survival. Most people are never taught to look for this date. They are taught to look for promotions, titles, houses, status symbols, bigger tax refunds, and a retirement age someone else normalized decades ago. They are told the basic script is 45 years of labor, a small raise every few years, maybe a gold watch at the end, if the company still remembers their name. And then, if the market cooperates and their knees hold up and inflation behaves and nothing catastrophic happens, maybe they get 20 years on the back end to enjoy the life they deferred on the front end. That is not a plan. That is a hostage negotiation with time, and the reason it feels normal is because everybody around you is repeating it. But repetition is not proof. If a million people walk in the wrong direction for long enough, it still does not become north. So let's strip this down to the two lines that actually determine whether you are free or whether you are economically trapped. Line 1 is your expense line. That is the cost of keeping your life running. Housing, food, insurance, transportation, utilities, childcare, debt service, subscriptions, every recurring obligation required to keep the machine of your lifestyle alive. Line 2 is your passive income line. And this is the one that matters more with every passing year because it represents income generated without direct labor in that moment. Dividends, interest, rental cash flow, if it is truly passive enough, and most importantly, the sustainable withdrawal power of invested assets. These are the only two lines that matter. Not your salary in isolation. Not your net worth screenshot for social media. Not the total number in your account as some abstract trophy. Freedom is not a number sitting on a statement. Freedom is the moment one line crosses the other. If your expenses are $6,000 a month and your passive income is $1,200, you are not free, no matter how impressive your car looks in the parking lot. If your expenses are $3,500 a month and your passive income is $3,700, you are functionally independent even if nobody would ever call you rich at a cocktail party. That is the first lie we have to dismantle. The total number is not the story. The gap between the lines is the story. The velocity of the gap is the story. The date those lines intersect is the story. Everything else is decoration. Once you understand that, the traditional 45-year career model starts to look less like wisdom and more like an accounting error scaled across an entire culture. The old model assumes you will need labor income for almost your entire adult life because it assumes expenses stay high, savings stay modest, investing stays incidental, and freedom remains a distant event scheduled for an exhausted version of you. The crossover point framework rejects all of that because it asks a more dangerous question. What if the target is calculable, compressible, and reachable decades earlier? This is where the 4% logic enters, not as a magic trick, not as a promise of certainty, but as a practical operating rule for estimating the size of your crossover fund. If you need $4,000 a month to run your life, that is $48,000 a year. Under a 4% withdrawal framework, you divide the annual expenses by 0.04, or more intuitively, you multiply annual expenses by 25. 48,000 times 25 equals $1.2 million. That means a $4,000 a month lifestyle is not asking for a lot of money someday. It is asking for a specific machine of about $1.2 million that can, under historically grounded withdrawal logic, throw off the spending power required to support that lifestyle. Now notice what just happened. The fog is gone. Retirement is no longer an age. It is a ratio, required labor at the back end. Years, not metaphorical years. Real mornings with alarms, real commutes, real meetings about priorities that are not yours. Once you see purchases through this lens, almost everything in consumer culture changes shape. The bigger kitchen renovation, the premium trim package, the wardrobe bought for validation instead of utility, the status vacation financed by future labor, the recurring subscriptions that quietly normalize financial drag. All of them begin to ask the same question. Are you buying this item, or are you trading sovereign years of your life for it? That is not an argument for living like a monk. It is an argument for radical honesty. Spend extravagantly where you truly derive meaning. Ruthlessly cut what is performative, habitual, or numbing. Because the goal is not deprivation. The goal is to stop donating your life force to things that do not meaningfully increase your life. Now, I need to be honest with you about the beginning, because this is where many people give up before the machine has any chance to reveal its power. The early stage, from $0 to $100,000 invested, is brutal. It is slow, psychologically unfair, and often humiliating because labor is doing almost all the heavy lifting while compound interest is still warming up on the bench. This is the puddle phase. Your capital base is so small that market returns, even when solid, feel trivial relative to the effort required to earn and save. You might invest $1,500 a month for a year and then see the market contribute only a few $1,000s, maybe less depending on volatility, and it feels like the whole dream is fragile. You think, this cannot be how people get free. But it is. Every system has a phase where effort appears disconnected from outcome. A flywheel looks motionless before it turns. Water looks calm before it boils. In the puddle phase, your job is not to be impressed. Your job is to persist. The objective of the first $100,000 is not merely financial. It is behavioral. It proves self-efficacy. It proves you can direct cash flow. It proves you can resist cultural pressure. It proves you can build assets instead of only consuming outputs. The first $100,000 is where you stop being a spectator and become a capital allocator. And once that threshold is crossed, the machine starts behaving differently. At $100,000, an 8% year is $8,000. At $250,000, it is $20,000. At $500,000, it is $40,000. Suddenly, the bench player checks into the game and starts scoring. You are still contributing, yes, but now capital has momentum. This is why people who quit in the puddle never get to see the river. They mistake the startup physics of wealth building for the permanent physics of wealth building. They think because the beginning is heavy, the whole journey will be heavy. Not true. The early years demand discipline. The middle years reward consistency. The later years become almost eerie because the portfolio starts throwing off more in ordinary market movement than you once managed to save in a full year of disciplined labor. That is the phase transition people call luck when they did not witness the first decade. And the lesson here matters deeply. You do not need immediate evidence that the process is glamorous. You need enough conviction to survive the ugly phase until math takes over. Because math, unlike motivation, does not need to feel inspired to keep working. And once you understand that, you also understand something else almost nobody teaches. Freedom is not binary. There is not just trapped and free. There is a gradient, and every step up that gradient buys back part of your life. Full crossover is one destination, yes, but there are powerful intermediate positions that dramatically change your experience of work long before you are completely done with it. This is where the concept of coast fire becomes so important, because it reveals just how asymmetrical time can be when used correctly. Imagine you are 30 years old and you have accumulated $150,000. If that money compounds at roughly 8% nominal over the next 30 years, you are in the vicinity of $1.5 million by age 60 without adding another dime. Even if we haircut expectations and think in more conservative, inflation-adjusted terms, you have essentially punched your ticket to around $1 million future simply by front-loading the hard part. That means from 30 onward, your life options widen dramatically. You could downshift careers. You could take lower-paying but more meaningful work. You could step away from a toxic boss. You could start a business with less fear. You could take a sabbatical without feeling like you detonated your future. This is the freedom gradient. The point is not that everyone should stop investing at 30. The point is that every dollar accumulated early has option value beyond its face value. It does not just buy future income. It buys present negotiating power. The bigger your assets, the less abuse you have to tolerate, the less panic you feel in every meeting, the less desperate every decision becomes. That is why I reject the idea that wealth is greed or excess or some shallow obsession with numbers on a screen. Properly understood, wealth is stored autonomy. It is compressed future permission. It is the ability to say no without collapsing. And if that sounds emotionally different from what you were taught, it should, because most people were taught to see money as consumption power, not sovereignty power. That misunderstanding is expensive. If you think money is mostly for buying stuff, you will keep buying stuff and wondering why you do not feel secure. But if you understand that money is primarily a tool for reducing compulsory labor, then your entire relationship to saving, investing, and spending changes. You stop asking, "Can I afford this monthly payment?" and start asking, "How many months of my life does this obligate?" You stop admiring raw income and start admiring low burn rates with high optionality. You stop envying flashy displays and start noticing who actually controls their time, because that is the tell. Time control is the visible symptom of invisible capital. So let me bring this home with the reframe that matters most. The real journey here is not from poor to rich. It is from economic slavery to sovereignty. Slavery is when your survival requires your obedience. Sovereignty is when your survival is funded by your assets and your choices no longer need permission from a payroll department. That is why the career model deserves to be audited so brutally. Not because work is bad, not because ambition is bad, not because building things, contributing, creating, solving, and leading are bad. Work can be deeply meaningful. The problem is compulsory work under financial fragility. The problem is having no choice. The problem is needing to trade your hours under terms you did not set because the expense line is always waiting with a knife at your throat. The crossover point changes the emotional architecture of existence because it severs that dependency. You may still work after crossover. Many people do. But now, the work is cleaner because it is elective. You can negotiate harder. You can walk away faster. You can choose mission over money when it matters, or money over mission when that serves the season, because the basic fact of your life is no longer that you must comply in order to eat. And that, to me, is the only kind of wealth worth envying. Not the penthouse, not the watch, not the vacation photos curated for envy. Wealth is the accumulation of choices. Wealth is the distance between what you could do and what you must do. Wealth is the calm that enters your nervous system when a job loss becomes an inconvenience instead of an extinction event. Wealth is the ability to help your parents, protect your children, leave a bad environment, fund recovery, fund curiosity, fund dignity. Wealth is not what you display. It is what you no longer have to endure. So if you feel overwhelmed by the target, good. That means you are finally looking at the real problem instead of decorating the false one. You do not need to solve everything tonight. You need to start measuring the right thing tonight. Find your expense line. Not the fantasy version, the real one. What does your life actually cost per month? Then, identify what can be cut without harming meaning and what should be protected because it genuinely matters. Track the gap between what you spend and what your assets can sustainably produce. Stop worshiping income that evaporates and start building income that persists. Respect the puddle phase. Exploit the double leverage of expenses. Treat big purchases like life years, not price tags. And above all, stop letting society sell you a 45-year sentence as if it were the natural shape of adulthood. It is not. It is merely the default outcome for people who never learn to draw the two lines and watch for the crossing. There is a date on your calendar when the old arrangement ends. Your job is to bring that date closer with every decision that lowers the target, raises the assets, and compounds your options. Calculate your crossover number tonight. Monthly expenses times 12 times 25.